November has been a month of volatility. We've seen markets swing back and forth, with investors searching for direction. Some days optimism drives prices higher, other days uncertainty pulls them back down. One of the big debates this month has been around artificial intelligence. Is there an AI bubble forming, or are we simply witnessing the early stages of a long-term transformation? We've seen companies raising significant funding to fuel their AI ambitions. For some, this looks like euphoria or frenzy. For others, it's a strong vote of confidence in the future of technology. Hello and welcome to Dividend Diaries. My name is MS and today we will discuss what is best for us in this uncertain environment. So here's the thing. When markets get noisy, it's easy to get distracted. That's why I believe it's important to go back to basics. Sound investment theories, proven best practices, and disciplined risk management. These are the foundations that help us grow our investments steadily, even when headlines are full of hype. Risk management in this kind of environment. Risk management becomes even more important. It's not just about chasing returns. It's about protecting the capital we already have. It's about making sure our portfolios can withstand shocks. Volatility reminds us that markets don't move in straight lines. They rise, they fall, and sometimes they stall. That's why resilience matters. A strong portfolio is one that can absorb uncertainty and still keep us on track toward our goals. So the real question is this: where do we put our money now? Do we stay defensive, or do we look for opportunities? And how do we position ourselves with the potential Fed rate change coming in December? For me, Europe deserves a closer look. Equities here are fairly valued compared to some overheated markets, and there are clear opportunities. One ETF I'm watching closely is the iShares MSCI Europe x UK UCITS ETF, currently trading around £44 on the LSE. This gives exposure to major European companies, excluding the UK, and provides a diversified way to capture growth across the continent. Another ETF I'm accumulating, especially on dips, is the Vanguard FTSE Emerging Markets UCITS ETF. Emerging markets bring diversification, demographic growth, and long-term potential. Yes, they can be volatile, but over time they add balance to a global portfolio. Of course, Europe and emerging markets don't mean we can ignore North America, but instead of the traditional S&P 500 index, where nearly 40% of the weight sits in just the top 10 companies, I prefer the equally weighted S&P 500 ETF. This way, all 500 companies are represented equally. It reduces concentration risk and gives a more balanced exposure to the entire US market. Global alternative for those who don't want separate ETFs for each region. There's the Vanguard FTSE All World UCITS ETF, VWRL. It's a simple, global option that covers developed and emerging markets. Just keep in mind it's somewhat dominated by US companies and isn't equally weighted. Still, for many investors, it's a convenient and stop solution. So, what do we do? Is it time to buy now or wait until the Fed's December decision? My view is, stay disciplined, diversify across regions, and focus on risk management. Markets may be volatile, but with the right strategy, we can continue to grow our investments steadily. What do you think? Are you buying now, or waiting for the Fed? Share your thoughts in the comments. I'd love to hear your perspective. Before you go, don't forget to subscribe to the channel for more investment insights. And if you'd like to continue the conversation, follow me on X at @DividendRover. That's where I share quick updates, charts, and ideas between videos. Your support helps me keep creating content that empowers investors like you.